Welcome to today's deep dive. So, if you're watching the charts, you've probably noticed that massive, like $68,000 iron ceiling hovering right over the crypto market.
Yeah, it's a heavy one.
Right. And today we're figuring out exactly who poured the concrete for that ceiling and, why they want to keep Bitcoin locked in this really tight consolidation range around 65,500.
Because it's not an accident.
Exactly. I mean, while this market operates 24/7, if you're only looking for price breakouts, you're honestly looking the wrong place. The real action right now is this massive silent rotation of capital.
It's a fundamental restructuring beneath the surface. The price action you're seeing isn't really the story itself. It's just a symptom.
A symptom of the macro squeeze, right?
Yeah, a symptom of a much tighter economic reality that the really large players are trying to navigate.
Let's talk about that reality because that 68K ceiling, it's backed by some serious macroeconomic headwinds. I mean, we've got Brent crude oil pushing past $99 a barrel now.
Mostly due to those shipping conflicts.
Right. And because of that, markets are pricing in an 80% probability that the Fed just holds rates, like right between 3.5 and 3.75%.
The era of free money is completely paused. And when borrowing costs stay that high, institutional strategy just shifts dramatically.
You can't just buy and hold anymore.
Exactly. You can't rely on cheap capital to just sit on an asset and hope for double-digit growth. You have to make the asset work for you.
It honestly feels like a real estate market where the investors have just suddenly stopped flipping houses and decided, let's just collect rent instead.
That is a perfect way to look at it.
Because if you look at the capital flowing into yield-generating products, it's staggering. Look at the YB ETF. It's paying a 46.14% dividend yield right now.
Purely from selling call options, too.
Yeah. So with institutions flocking to that kind of passive income instead of buying the underlying asset, is spot Bitcoin losing its institutional luster entirely?
Well, the institutional landlords have definitely moved in, to use your analogy.
Right.
They aren't looking for a quick flip. They're optimizing the property for a high-rate environment.
Which is just market maturation.
It is. But you do have to tread carefully here, because predictive models, like the ones from Forex.com, they're actually warning of a downside price bias heading into Q3.
Because of the tighter money supply.
Right. So institutions are squeezing the asset for yield on one end, but then you look at the physical producers, the miners, and they're getting aggressively squeezed on the other end.
And it's coming from an entirely different industry, which is wild. Like, we're in the middle of a literal resource war over electricity right now.
Oh, absolutely. AI versus mining.
Yeah. The White House just launched the Genesis Mission 2026, and it explicitly prioritizes federal power grid connections for AI applications.
Because, an AI data center can generate just exponentially more revenue per kilowatt hour than a Bitcoin miner can right now. So power companies are naturally going to prioritize those AI contracts.
Which totally explains why the revenue miners actually make for their computing power. Their hash prices tanked. I think it hit multi-year lows of $30.60 per petahash.
The profit margins are just dissolving.
Right.
And we're seeing the corporate casualties happen in real time. Satsuma Technology just had to liquidate 668 Bitcoin at a massive loss.
Oh, wow.
Yeah, they basically wiped out their equity just to pay off their convertible notes, the short-term debt they used to fund operations.
Wait, but if AI data centers just gobble up all the cheap power and put these miners out of business, aren't we effectively starving the network's long-term security model?
That is the structural threat hanging over the whole industry right now. Energy access now definitively carries a higher valuation for AI than for mining operations.
It's a permanent shift.
A permanent physical shift in how digital infrastructure is powered, yeah.
So, okay, if the miners are getting squeezed by AI and institutions are retreating to yield, where does that leave the everyday trader? Especially since incoming regulation seems to be slicing the market right down the middle.
The regulatory friction is forcing a complete bifurcation. On one side, you have the Clarity Act advancing,
which would outright ban federal officials from issuing or promoting crypto.
Right, and the stakes there are immense. Donald Trump reported $1.4 billion in crypto income for 2025 alone.
It's massive.
And at the exact same time, you have legacy banking groups fiercely lobbying against stablecoins paying yields to their users.
Because they're terrified of a deposit flight. It's a $6.6 trillion deposit flight risk.
Exactly. If you can get a high, safe yield on a stablecoin, Why would you keep your money in a traditional savings account?
Mm.
The banks are quite literally fighting for their survival.
So traditional finance is clamping down, and then legacy offshore platforms like BitMEX, they're shutting down completely this September, which basically means retail capital is panicking and fleeing straight into wild speculation.
Meme coins and leverage.
Right. Over on the Robinhood chain, you're seeing meme coins like Jimothy surging 100% in a day. But then in that exact same 24-hour window, cross-chain bridges are losing $35.5 million to security exploits.
It's pure chaos on that side. The middle ground is just vanishing. So for you as an investor, it means navigating a market split completely in two.
Regulated yield for institutions and ultra-high-risk playgrounds for retail.
Right. Which leaves you with this final puzzle to think about.
Okay, what is it?
Well, with Japan eyeing formal Bitcoin ETFs by 2028 and U.S. banks fighting stablecoins just to maintain their deposits, are we currently witnessing the final, irreversible gentrification of decentralized finance?
Man, that is the million-dollar question. It really does seem like the days of flipping the digital house are over. The big banks are moving in, AI is buying up the grid, and everyone else is just left paying the rent.